let's delve deeply into NVIDIA. First of all, NVIDIA announced their quarter last week, specifically on August 28. And I think the only real sin that they committed is that they didn't beat the Wall Street estimates, either with what they reported or guided to for the next quarter by enough. So in the quarter just announced, they beat the Wall Street earnings estimate by 6%. Now, a year ago, 4 quarters ago, they beat the Wall Street estimate by 19%. And so, are we seeing a growth slowdown? Not necessarily, but we are seeing smaller and smaller beats versus Wall Street expectations. I don't think a stock should be punished this much on that. The other thing that I think is interesting is the average company in America, or the average company in the S&P 500, has a gross margin of about 40%. The gross margin at NVIDIA will start to shrink a little bit as the company continues to expand, but the guidance from the company is for a gross margin of still to be 75% this year. You guys, 75% versus 40% for the average company. That is more like a software company margin than a semiconductor company margin. But remember, it's not just a semiconductor play. They have that ecosystem and AI infrastructure building. Just like years ago, Apple had that ecosystem with all their interrelated products in the 90s and the early part of the 2000s when it rose to be the world's #1 market cap stock. Now, their next generation of chips at NVIDIA is called Blackwell. And they did, as was reported in some periodicals a couple weeks before they reported, they actually started the slide in the stock. They did have a manufacturing glitch. But I don't think it's that big of a deal because it's about a 90-day delay. Who cares? That's just 1 quarter. And they're so far ahead in all other aspects of their business that this is not going to be lost revenues to AMD or anybody else. It's just going to be deferred. And if it's just deferred for 90 days, who cares? Don't overreact. And it looks like they have already started to implement a new photo mask. And a photo mask is a part of the etching process for semiconductors. So they have the new photo mask that should solve some manufacturing issues. The new products are sampling, and they're going to be just fine with the Blackwell chip. Don't stress. But one of the reasons for, at least in the near term, for their gross margin to fall a little bit is extra cost of goods sold or extra manufacturing cost for this fix. Again, don't stress too much. Today, and this is probably something that we have to worry a little bit more about, whatever happens is when you are on a pedestal like this company has been for a couple of years, all your competitors want to knock you off. And so all of NVIDIA's competitors have ratted on the company. And now the Department of Justice here in the United States has issued a subpoena to the company for an antitrust inquiry. So whatever happens in these situations, maybe they have to change their business practices with how they sell products a little bit. I think it would just be a tweak. And then also, when you have these legal issues, they are not solved in months or quarters. Sometimes it's years. So I don't see this having a material impact for NVIDIA anytime soon, and maybe never. And the valuation, I get some pushback from people and they say, Paul, how can you like this stock? How can you think it's not overvalued when it tripled last year and it's working on a double this year? But here's the rub. Its earnings, sales, cash flow have grown even faster. So this is not a situation where the valuation expanded on this company. It's still at the same price ratios, things like price to earnings, price to cash flow, price to sales, but all those metrics have just popped so much. So consider this. Next year, so this is the fiscal year ended January 31, 2026. NVIDIA is supposed to grow its earnings per share by over 40%. Its PE ratio today is 29 times earnings. So look to the PE to growth ratio. In the numerator is 29 times earnings. In the denominator is the growth rate, 42%. So this is a stock that is trading at a PEG ratio of 70% or only 0.7 of 1. When you look for stocks that are cheap, you're looking for PEGs that are less than 1. And here is 1, 0.7. So it's not expensive. I can make the case as cheap. And if you want to do the ultimate compare and contrast, take a look at Apple. Apple today trading at 33 times next year's earnings. Remember, NVIDIA is 29 times. But Apple's earnings per share growth is only supposed to grow 11% next year. So it has a PEG ratio of 3 times. Its PE ratio is 3 times its earnings growth rate, where NVIDIA's PE ratio is only 70% of its earnings growth rate. Which stock is more expensive? Apple, I say.